Oh, good question. How are the HSA tax benefits different from the Roth IRA? Don't they both grow tax free? Yes, they do. Great question. Let me show you why I prioritize HSA over my Roth IRA. Let me pull this up real quick. So, the HSA allows you to make pre tax contributions, which means it will lower your taxable income every year. That's on top of the standard deduction. Okay. And it could potentially save you hundreds, if not thousands, in federal and state income taxes every year, depending on your marginal tax rate and the state you reside. Oh, unfortunately, you're not going to get the tax benefit if you live in California or New Jersey. They're not going to reduce your taxable income for the state income tax. You'll still be able to reduce your federal income tax, but not the state income tax. But anyway, your employer could give you an employer contribution to the HSA or just a straight up contribution based on your employer. Okay. But keep in mind that unlike the Roth IRA, you don't need to have an earned income to contribute to your HSA. This is the HSA and Roth IRA comparisons. You just need to be enrolled in a high deductible health plan. When you start investing, your HSA will grow tax-free inside your HSA and reimburse yourself at any time as long as you have the medical receipts, proof of medical expenses. And then after age 65, you can use the HSA for anything and not owe any penalties, but you will owe income taxes on the non-medical distribution. So when you're 65 and you're like, I want to take that HSA out and buy a house, go on a vacation or whatever, gift it to somebody else, you're not going to be penalized for 20%, but you will owe federal and or state income tax depending on the state that you reside in. So, and for the Roth IRA, the contributions have to be in after tax dollars from your checking account. So if you compare it with the HSA right here, okay, you don't get your taxes reduced from the contributions. With the Roth IRA, you don't get an employer match or employer contribution, but the investments inside the Roth IRA will also grow tax-free, just like the HSA. And when it comes to the withdrawal rule, the HSA is stricter than the Roth IRA because I need to provide proof of medical expenses in order for those withdrawals to be tax-free, right? But with the Roth IRA, I can withdraw what I contributed to the Roth IRA at any time, tax-free and penalty-free. What I cannot withdraw from my Roth IRA until I turn 59 and a half is the earnings and interest that accrued inside my Roth IRA. So for example, if I contributed $7,000 this year and earned $500 in dividends and earnings, then $7,000 is what I can withdraw at any time right back into my checking account, tax-free and penalty-free. But $500 is what I have to wait until I turn 59 and a half. The other thing to keep in mind is that if you don't follow the rules, the IRS will penalize you 20% with the HSA compared to 10% with the Roth IRA. So I hope this chart can clear things up when you try to compare a Roth IRA to an HSA. Really good question. It's just that that's really the reason why you prioritize HSA over Roth IRA is because of that pre-tax contribution as opposed to after-tax contribution. And then this one you get penalized for 10%, which you shouldn't take it out before you're 59 and a half. And then this is 20% penalty, non-qualified medical expenses before you're 65. So there are pros and cons, but you can compare the two. But right now, as a hyper accumulator, saving and investing for FIRE, I am going to take advantage of pre-tax first, if that's the only investment vehicle that I can contribute now. But right now, I max out both HSA and Roth IRA. So $8,300 for the family. And then my wife and I, we contribute each $7,000. So she contributes $7,000, I contribute $7,000. Oh, another thing to compare is this is age 55 and this is age 50 for the catch-up contribution. So Roth IRA catch-up contribution is the year that you turn 50 years old. And for HSA is the year you turn 55 years old. So if you're turning 55 this year in 2024, it doesn't matter when you turn 55, from January 1st to December 31st, you can make that catch-up contribution for $1,000, okay? If you're on a family plan for one HSA account for the family plan, you can only do one catch-up contribution for $1,000. However, you can do two $1,000 catch-up contributions if you and your spouse have two separate HSAs. So if you have an HSA and your spouse has an HSA, both of you are 55, then your spouse can contribute that extra $1,000 and you can contribute an extra $1,000. So that's one trick that you can do and really great benefits with the HSA. So check it out. Really good question.